Good morning. I'm here today with Andrew Lowe. Andrew is with UBS. He's a financial advisor. And today we're going to be talking about how to use a charitable remainder trust to avoid paying capital gains taxes when you sell your home. And also, which is amazing to me, create a lifetime stream of income that's guaranteed, not only for the rest of your life, but as we'll learn, for a period longer beyond that period, up to I think, Andrew, up to 20 years, or maybe there's a longer period than that. Anyway, Andrew will get into the details of this. My name is Will Flanagan. I'm a realtor. I specialize in helping seniors who are thinking about downsizing. I also work with property owners who are owners of multifamily properties and looking to either sell those or buy those, in addition to helping first-time homeowners if they're looking, new couples who are looking. In fact, I just helped a couple buy their own home this week. So if you have any questions, you can certainly send them during the chat. This is going to be recorded, and we're going to rebroadcast this presentation on YouTube and Facebook and LinkedIn. So if you have to drop out before the end of this presentation, just let me know. It should run about 30 to 45 minutes. It's going to be a presentation, but Andrew and I are going to have a conversation because I think it'll be more interesting and useful for me to kind of move the topics through as Andrew's going through his presentation. So Andrew, why don't you go ahead and introduce yourself and tell us a little bit more about your background, and then we can get into why charitable remainder trusts are such a powerful tool for people who are concerned about paying taxes. And I don't know anybody who likes to pay taxes. So avoiding paying a big tax hit when you sell your house, it's important because I've met quite a few seniors who were concerned. And this is, interestingly, one of their principal concerns and one of the reasons why they may stay in a house longer than they would normally want to, because the idea of paying the government several $100,000 or even several $1 million is quite painful to a lot of folks who've worked their whole lives and saved. But Andrew has a great product and a great deal of experience helping people understand that there's a way to get around this, and it's perfectly legal. And so Andrew, go ahead and introduce yourself, and let's learn more about charitable remainder trusts.
Yes, thanks, Will. Thanks for having me be your guest. For those that are clients of Will, you're in good hands. And the reason is that Will, he's not just a real estate broker and agent. He's really looking after the integrated well-being, kind of holistic approach to taking care of his clients. So making sure they find the right home, making sure they sell for the right price, but making sure that they not have to pay any unnecessary taxes, and really get the most bang for their buck, and really looking at it holistically. So thanks, Will, for having me on. Your first question to me was my background. So Andrew Lowe, I was born and raised in the San Fernando Valley here, and one of 5 kids to my parents who were immigrants from China. And my dad served in World War II, served for 5 years in World War II. And actually this year, he passed early. His health was compromised, but this year would be his 100th birthday. And so we sorely miss our father, and but he's in a great place with our Heavenly Father in heaven. So, but that's my background. I've been in financial services for close to 30 years. The last 22 plus working primarily with business owners and people with appreciated real estate who have a big problem when they're selling or even thinking about selling. They hate paying the tax, either the capital gains or the income tax. So I really do a lot of listening. I'm a scalpel and a compass. A scalpel that cuts to the heart of issues, and then a compass that gives sharp focused direction. I do a lot of listening, really try to understand what their priorities post-sale is, what their lifestyle looks like, what type of income they need, how they want to take care of their families and different things, and then create a customized plan to meet those priorities, but at the same time reduce their income and capital gains tax, as well as potentially gift and estate tax as well. And so again, I've been doing that now, focused on that for the last 22 years. And so today, we've had some different discussions, and again, I appreciate what Will does, but he has he brought up to me certain situations for his clients, and so he wanted me to talk about shared remainder trusts, and I've done a lot of those and done some planning for that. A shared remainder trust has the benefits of a couple of different things. When you sell your real estate, uh, whether it's a home, whether it's a rental real estate, or even a commercial building, whether it's a single family home or your own home, you can when you sell at that time, if it's transferred into a shared remainder trust, the trust is tax exempt. When the trust sells it, it pays no tax upon the sale. And in addition, there's a double tax benefit. You get an income tax deduction, and then you get an income stream for the rest of your life. If you're married, well, I'm married. So if I were to do a shared remainder trust, if I were to pass away, my wife gets the income stream. If she were to pass away, I get an income stream. And then after we both pass away, whatever's left goes to a charity of your choice. And but the other thing that it does well is that it gets this asset out of your taxable estate. And so as the estate tax exemption is going to sunset at the end of 2025, back down to 5 million indexed for inflation. So indexed for inflation, 2010 inflation. So probably around 5.8, 5.9. For those of us in Southern California, that increasingly is an issue. And so if we can remove that piece of property and asset from our estate and still benefit from it, you get the best of both worlds. Now, if we remove a $3 million piece of property out of our estate, and the estate tax rate is 40%, we just save 1.2 million for our kids. So those are some different ways. Later on, I'll go into some examples and strategies, but Will and I discussed that the best way to do this is maybe he's had a lot of questions, and there are certain questions that are that seem to come up often. And so maybe I'll just address those questions one at a time, and then maybe I'll go through an example. But before I do that, I do want to add a disclaimer. I'm a senior vice president with UBS, and UBS is a global wealth management firm. Actually, we're the largest global wealth manager in the world. But UBS does not give legal or tax advice. So any of the strategies I'm giving today is educational, is not meant to be and construed as legal or tax advice. Please consult your legal or tax advisor for your specific situation. All right, so I'll turn that over to Will.
I will piggyback on that disclaimer. I'm a former attorney, but I don't practice law. I'm not authorized to practice law, and any advice you get from me is not coming from a tax attorney or anything like that. So, with any of these presentations, you always want to reach out to your personal accountant or your attorney, someone who's licensed and qualified to give you the appropriate tax advice for your own particular situation. This is an educational webinar intended to introduce the concepts to you, but the specifics of your own situation are unique, and that's why you need to talk to your lawyer or your CPA.
And for those who don't have a CPA or this is an advanced estate planning technique. For those that don't have an advanced estate planning attorney, either myself or Will can introduce you to those that are qualified that can act on your behalf.
100%. So Andrew, why don't you go ahead? You can share the screen. Why don't you pull up your first sample, and we can kind of dive into, the specifics of how a charitable remainder trust works. And you've got some numbers that I think are pretty relevant to a lot of the people who might be watching this in terms of the estate that they have. Now, I will note that on one of the example that you're going to use, these don't include all the deductions that you're potentially entitled to as a home seller. If you're a married couple, you can deduct a $500,000 from the profit of the sale of your house. Right now, we're trying to keep the numbers simple. So when Andrew shows you his slide, you'll see that the initial number is the basis, meaning what you paid for your house when you bought it. So for example, if Andrew pulls up, he's going to pull up a slide here in a second. If you bought your house in 1990, call it 1992, since it's easy to do the math. So 30 years ago, you bought your house, maybe you bought it in Pasadena for $200,000, and which seems impossible now. But now that house is worth, let's say it's worth $3 million. And if you bought that house for 200,000, that's your basis or your cost. And here, well, we'll call it 300,000. So you can see on this chart here, the property, the value, the current value, we sell your house for 3 million. What you initially paid was 300,000. Your gain is 2.7 million. So Andrew, why don't you take it from here?
Yeah, so I know a couple of questions that you had asked me for several of your clients was that you had asked me that, you know, you have some families that have been wanting to either downsize or they've been wanting to sell their house, but then as you get closer to it and then, you know, they would approach you to list it, you know, they realize that they have to pay a huge capital gain because they bought their house in the 70s and 80s. You know, they bought it for 300,000, and now it's worth 3 million. And if they were to sell and they have not, you know, and they haven't haven't used up their exemption amount, you know, the gain is $2.7 million. So they got to pay tax on that $2.7 million. So so here's a way where you don't have to pay the tax on the sale. You transfer title to the charitable remainder trust, and the trust sells it. When the trust sells it, you pay. There is no capital gain due upon the sale. But we put $3 million in. Let's say that Will sells it for 3 million, and so now there's 3 million inside the trust. On this particular case, it will pay out an income stream of 5% a year. So 5% a year, if you see the right here.
Can I pause you real quick there, Andrew? So
Yeah.
once it goes into the charitable remainder trust, are the homeowner still entitled to take the either 250,000 for a single person or $500,000 deduction for a couple, or does that get eliminated once it goes into the trust?
No, they can still take that. They can still
Okay.
so some people they'll split that. They'll split. Let's say the house is worth 4 million, right? They'll split it. They'll put 3/4 of a house in charitable trust, so 3 million, and they keep 1 million out of it. They get to use their exemption for the 25% that they sell, right?
Got it.
So
So
let's
that's
not
helpful.
get let's not that's a little
Not
bit
get too complicated.
complicated, but let's just go through this. So there's 3 million inside the trust, right? The house is sold, you pay no capital gain. You avoid the capital gain of 2.7 million. And in this case, you know, maybe I can just make it a little bit smaller here. Make it a little bit, there we go, a little bit smaller. This is you know, prepared for John and James, age 64 and 56. Their income tax deduction is 812,000. So you avoid the capital gain of 2.7 million, and you get an additional income tax deduction of 812,000 to offset any other income that you might have, pension income, other rental income, any other income that you have, and you have 6 years to use this tax deduction. So you avoid the gain of 2.7 million, and you get an income tax deduction of 812,000. And your estimated income, you would get about $150,000 a year for the rest of your life. If John, who's a little bit older than Jane, if John were to pass away, Jane still gets the income for the rest of her life. If Jane passes, John still gets the income. The IRS, in the IRS mortality tables, estimates that at least one of them will live 36.8 years, call it 37 years. Income over that time would be a little bit over $8 million in total. And so again, this is, and then whatever's left would go to a charity of their choice. So let me just go to the next slide. Any questions on that first, Will?
No, that's really pretty. I mean, look, if you're watching this and you're like, wait, what? This is a time where you send me a message, or you send me or Andrew an email, and but more appropriately Andrew, because he can talk you through the details of it. But yeah, I understand it. But again, if you have any questions and you're watching this video at some point, feel free to message me or Andrew. Our contact information will be included.
So some of the questions I get asked is that, okay, I just did one for someone selling their home in Brentwood, and another lady selling their home in Rancho Palos Verdes, and so the question was that, well, um, if my husband passes away, what happens to his half of the income stream? I go, no, if he passes away, you get the entire income stream until you pass away. None of this money goes to charity until both of you pass away. And that was something that she felt secure in, that she's got a secure cash flow income stream for the rest of her life. So let me go to the next slide. So it's by contract. So the contract says pays 5% a year, right? We can also set the contract to say that the trust pays 6% a year. So if it pays 6% a year, then the income stream will be $180,000 a year. The income tax deduction will be a little bit lower, $634,000, although that's plenty for most people. But you still avoid the gain of $2.7 million. You get an income tax deduction, you get a little higher income stream, $180,000 a year. So let me go to the next page and show how the income stream looks. So the income stream starts here at 5%, again, $150,000 a year. And then every year it increases a little bit, 153, 156, 159, 162, 165. So there's an assumption here. We're paying out 5%, but we're growing the assets. It gets invested and it's growing at 7%. So it's growing at 7%. We're paying out 5% every year to you. And so there's a little bit of growth every year. So you get 5% of whatever is in the trust at the beginning of every year. So if we grow it 7%, we pay out 5. The next year it's got $3,060,000 on it, and 5% of $3,060,000 is $153,000. So nothing ever grows in a straight line, but this is, conservative. We can expect that that this is a potential possibility where there's a growing income stream. So by the time that they're near their useful life, right? They're 36.8 years. They're going to be getting almost close to $300,000 a year of income. Okay.
Now
Again,
this is projected returns based on conservative investments, right? This is not an annuity that's locked in. So your returns could actually be higher.
It could be higher. Like in 2020 and 2021, returns typically have been higher, right? 2022, the market's been challenging and returns are lower. And so nothing will ever be growing at 7% every year. So it's just kind of a fair estimate. But the key is that for most people, they want a growing income stream.
Right. Now, is this principal at risk though? Are people like with a regular investment, are they subject to, the fluctuations of the market going up and down? So I know that people are always worried about, the stability of the stock market. It's been doing so well the last 10 years. So I guess my question is, how do people know how much they're going to get if they're counting on this as their income stream?
They'll get 5% or whatever is the principal every year. And so it does fluctuate. We can fix it. There's other types. There's a shorter remainder annuity trust where it fixes the payment every year. The tax deduction is a little bit lower, but that's for another illustration at a different point in time. So you can fix it. You can do a shorter remainder annuity trust where it fixes the payment every year, right? But most people like this because they get a growing income stream. Okay. But it does, let's say that we make nothing. The markets don't perform and you made zero for that year, right? You pay out 5%, so you pay out 150. Now the trust has 2.85 million in it, right? At 2.85 million, the next year they'll get 142,500. So they'll still get an income stream. So if it did absolutely zero, they would get 142,500 the next year, right? But then let's say it grows to 3,060,000, and then we pay out 153, and it grows another 2%, So 3.121, you get 156, and then it goes to 3.183, they get paid 159. And let's say the following year they get nothing, right? And then if you subtract that 159, so now it's 3,024,000, you're still gonna get 150, a little over 150,000 for that year because the principal has been higher now, right? So that's at 5%. I can show it where we show it at 6% as well. At 6%, they start out at 180,000, and then it just grows a little bit year because we're showing paying out 6%, but we're only growing at 7%, so there's a 1% net growth. So by the end of their lifetime, since they're taking out more earlier, they might get 254,000, right? So then there's another question. Another question that people ask me is that, well, we've got great bloodlines, and we've got great longevity in our family. What happens if I live longer than what the IRS says I should live? I live longer than, my husband and I, who's 64 and 58. They live longer than 36 years. Well, you continue to get the income stream until the second spouse dies, passes away. So, here it's 299. So you just keep going. It keeps going until the second person passes away.
So let's take the opposite of that, Andrew. What if, tragedy befalls both couples, say they're in a terrible accident of some kind, and they both pass after a couple of years? What happens to that income stream? Does it just go away, or does it get passed on to beneficiaries, or what happens?
No, that's a very good question. So we can do what's called a 20-year guarantee. So let me go through that one here. 20-year guarantee. So this is 5% payout with a 20% guarantee. Can you guys see that okay?
Yeah, that's good.
Okay. So here, the payouts will still be the same. So there's a 20-year guarantee. So let's say that you and your spouse, I know, Will, you're married too. Let's say that you passed away. Let's say that you guys plan, you've been locked up in the pandemic, and now you're finally getting ready to travel, right? And so you go to Spain or you go to France, and you and your wife, die in, unfortunately, in an airplane accident, right?
I'm knocking wood right now.
Knocking wood, right? and I mean, obviously that we're not wishing that anybody, and that's very, very, very unlikely to happen. But anyways, let's say it does happen, right? Then you can do it where you have a 20-year guarantee. So this income stream would be for the longer of you and your wife's lifetime, or 20 years. So if you pass away in year one, the rest of the 19 years or 20 years of income flow will go to your kids. So this is a great way to provide some security for your kids if you unfortunately pass away too.
Okay.
So that income stream can go to what's called a successor beneficiary. That successor beneficiary could, I have two kids, right? So I can split them 50-50, where it would go to each of my two, kids, 50-50, that income stream. And then after 20 years, because it's guaranteed for at least 20 years, then whatever's left there then would go to a charity of my choice. So then I know you asked a couple of questions. My families, the families that are calling me, they their priority is their kids and their family, and they have some charitable interest, but not a whole lot. And right now, they're not sure what charity they want to give to. So the charity can be very different, or not very different. It could be a variety of different things. It could be the Huntington Library, right there in Pasadena. It could be Descanso Gardens there in La Cañada. It could be the Walt Disney Center or the J. Paul Getty Museum, or
Or it could be a hospital or the American Cancer Institute.
American Cancer Society. It could be to your local church. It could be
your university.
Salvation Army. It could be Samaritan's Purse to help with the poor. It could be either one of these. However, if you name that charity, let's say you name, let's say I had a client named the Ronald McDonald House, right? So they named a Ronald McDonald House as the remainder beneficiary. But mind you, they're not getting anything for like 30 years, maybe 40 years, right? So the Ronald McDonald House may change in the next 10 years, and you may not like them anymore, right? Or even your university, they may have changed and their priorities changed, and they're just their viewpoints are just way off the charts now, and you don't like them anymore. You're kind of stuck. And so what I suggest is that they create their own what's called donor advised fund. And so that's kind of a conduit account where that money flows into. And then it's a charitable account meant to be dispersed to charity, but it's kind of like a holding tank to be given to charity. And then when you and your wife
So
pass away,
Andrew, would that be part of the trust, the charitable remainder trust? Would that be part of that, or would
yeah,
that be another entity below that?
no, we would name the charity in the charitable remainder trust document. So that could be another entity. And so what we would do is we would call it the Will Flanagan Charitable Gift Fund. And so it's just an account where when you pass away, when you both pass away, this money goes into this account for charity, and now your kids can then decide where that money goes to over their time period at their will, at their desire, at their leisure. So
Got it. But
basically, it almost works as a piggy bank for them to give to charity. They don't have to give every year. They can find things that they're interested in giving to, but it has to be to approved 501c3 legal charities.
yeah, they
Right?
can't name themselves as a new
No,
charity.
no, it's not. It can't be to the Andrew Lowe Slush Fund, right, or anything like that, right? It has to go to approved charities. So that gives the family a lot more flexibility, and it also fosters. So I've done it where I've done it where for this family they have 5 grandkids, and they give them the right from the charitable gift fund to give away $5,000 to a charity of their choice. So now these kids and I advise them, hey, give them the ability to give to a charity of their choice when they reach the age of 10 or 11. So what does that do? Not when they're age of 10, 11, but it has to be approved by the board, right? So we create the pseudo board. It's mom and dad, their 3 sons, plus their 3 spouses. That's the board. And they have to present to the board. What does this do for 10 and 11-year-olds? These 10 and 11-year-olds now have to do 2 things. They have to learn presentation skills. They have to present to the board. 2, they have to research charities. You can't just willy-nilly give it to the LA Zoo or Huntington Library or whatever, Arboretum or whatever. They have to research the charities and explain why that's a good charity to give to, what their expenses are, and so on and so forth. And so it allows a sense of family community and continuity. One of the goals for this family was that their 3 sons are pretty close, but they're concerned that their grandkids would get scattered, that there's no relationship because they're kids from 3 different families now, right? So this creates a way for family continuity for another generation into the 3rd generation, because now they have to, they can give, so they can use this gift fund to do that. The last point that we made there was that all 5 grandkids have to decide unanimously where a final 10,000 goes. So
Got it.
now these
So
5 grandkids at the age of 10, 11, 12 years now have to collaborate, argue, convince, persuade, argue some more, convince, persuade, argue some more. They have to agree to where the final 10,000 goes to. So
hey,
later on
Ken,
when they're adults, let me just finish this. Later on when they're adults, now there's a working history of these grandkids all working together. And that's really what that's what really the mom and dad or the grandparents wanted.
right now you can set it up like this, but you don't have to set it up like this. You can
Oh,
make it
no,
much easier
yeah,
or on autopilot. And we talked about this a little bit previously, Andrew, that this is better than, or at least more flexible than, and less expensive than trying to create what's called a family foundation,
correct.
which you'll see big foundations, whether it's the Gates Foundation or other people that are multi-billionaires. They have the resources and the infrastructure to create these kind of things, but there's more tax implications and more management that might take more professionals involved to run a family foundation. But this DAF, the
Donor advised fund.
the donor advised fund, kind of gets you the benefit of having your own family foundation, but more the flexibility and less expensive or cumbersome to operate. Is that correct?
A lot more flexible and less expensive and less you don't, there's less rules to abide by.
Right.
For example, yeah, so I'll just leave it at that.
Mhm.
But let's flip back to the other thing, Will, is that some of the families are, and maybe I'll stop sharing the screen for now.
Sure.
Okay. So some of the other families that you brought up and I've come across too, they bought a house and then they move into another house and they use their old house as a rental. And they've been doing 1031 exchanges, and then now they're to a point where they don't really want to do any more 1031 exchanges. They're kind of tired of the real estate. It's been a hassle, and then dealing with tenants and dealing with COVID and just all this stuff, right? So they want to sell, but now because they did 1031 exchanges, their basis is virtually zero. But they're concerned about that, and also worried about, well, what are they going to have to replace the income stream? So this really works well for that. If they have a rental home or different thing and the base is very low, we just transfer title in the charitable trust. The trust sells it. You avoid the capital gain. So even though you did 1031 exchanges 2 or 3 times, and you have this deferred capital gain, now when you sell it that way, you don't pay a capital gain. And the income stream oftentimes replaces what you're doing. So you asked me to share the example of the lady in Ranchos Palos Verdes
Sure.
who had 5 rental homes. She bought one home in Redondo Beach, and she it was worth about $3.7 million, but she bought it in the 70s for like $100,000. So there's $3.6 million of capital gain in there. Just after paying property tax and everything, her cash flow was $105,000 a year. If she had to pay, if we were to sell the rental home and she was wanting to do it, she'd have to pay taxes on $3.6 million of capital gain.
And that would equal about what? Almost $1 million, I would think, or maybe a little lower.
3.6. Yeah, at the between state and federal would be over $1 million.
Right. So that's a big hit. So that money doesn't, with a charitable remainder trust, that money all goes into a pool to start working for you to create this lifetime, right, this cash flow for the rest of your life, which, I know a lot of people that manage properties, whether it's a single family home or, fourplex or whatever. And just think about the benefits of that in your retirement, you don't have to answer the phone when your tenant's plumbing is going bad or the roof needs to be repaired, or all the hassles that go along. Because I've owned and managed properties for other people and for myself, and it's a lot of time and commitment. But imagine if you could take the income that you lost, actually make more money without doing any of the work.
In her case, yeah,
no brainer.
In her case, she was getting $105,000 net after paying property taxes, right? From the charitable remainder trust, she was going to get somewhere between $180,000 and $185,000 a year, and probably growing to somewhere around $220,000 a year. So the real estate, the attorney who referred the case to me, thought this was an absolute great solution for her. That she's going to get a higher cash flow. And we removed that $3.7 million asset out of her estate. So now she's underneath the exemption amount for paying estate tax. And then $3.7 million of moving it out of the state, we just saved them, let me do the math here real quick. We just saved them $1.4 million of estate and gift tax.
Because that comes after, and you can transfer that in the trust, right? Without that capital gain, without that estate tax.
Yeah, because you remove the asset from your estate. So even though you're getting the benefit of the cash flow and you're benefiting from this asset, it's technically not yours, so it's not part of your taxable estate.
Right. So what you were talking about at the beginning of the presentation about in 2025, right now the limit is about a little over $12 million that you
Yeah,
can transfer without a estate tax, and it's going to drop. Is that
yeah,
right?
12,060,000 this year. Last year was 11,700,000 some thousand. This year is 12,060,000. If you're married, it's 24,120,000. But when President Trump passed the tax law changes, Congress only approved it for 10 years. So
Okay.
that ends December 31st, 2025. Um, and so it was not Trump who passed it, it was Congress that passed it, but ended December 31st, 2025. So in 2026, your estate and gift exemption drops down to 5 million. It's indexed for 2010 inflation. So the estimate right now is about 5.8, maybe 5.9 million.
Wow.
The current administration and the current president is trying to reduce that exemption even further. They had proposed to reduce it last year in September to 3.5 million, or even back down to 1.5, but it wasn't passed. But there's we hear things that they're trying to resurrect and try to get something passed to reduce it. But we'll see if Congress has the appetite to pass something like that. But if nothing passes, we do know that it'll go back to the $5 million exemption index for inflation in 2010.
So that means if you have properties that are over that 5 million, whatever, 5 million, 5.8 million, then you're going to pay basically twice. If you don't, you're going to pay a capital gains tax when you sell. And then if you still have value, a property over that 5.8 million, say you have, multiple properties, you would then pay an estate tax when you pass away.
Yeah, let's say that you have a rental home for 2 million, your own personal residence is 4 million. You have other assets. You have a retirement account. You have a 401k with another million. You've got investments worth another million, and you have 2 other rental properties for 2 million each. So let's say your estate is 14 million, right? You're going to, and they add everything up. I mean, your jewelry, your autos, everything gets added up as part of your estate. So whatever's left at the end of the day when you pass away, you have to file an estate tax return and do a valuation of all your property. And if you're over that exemption, the current tax on that is 40%.
Wow. So
So
if you had that 14 million, you'd be paying 40% on the 2 million that would be over that limit, right?
right, right.
That's
So
a lot of money.
it is a lot of money. So if you remove the estate or the asset from the estate, like remove the house or the rental or the commercial building out of the estate, you get an income stream from it, but the IRS doesn't count as your estate. Now, and so, and then 1031s are great ways to do things in exchange for property. So you defer the tax, but it doesn't eliminate the estate and gift tax. Eventually, that's still part of your estate.
Right.
And you
And
get
it also forces you to, continue to potentially be a landlord with all the costs and the
yeah,
aggravation and the liabilities that go along with owning property like that.
and you get no income tax deduction.
That's true.
Now, some people ask me about the cash flow. So that 150 or 180,000 a year, right? How is that taxed? So some people ask me that, and so we try to manage it. I would manage the assets inside trust. It would be taxed. We try to keep it to mostly long-term capital gain income. So that's going to be at a lower rate than ordinary income. So remember uh, uh, so that's how we try to do it. So the long-term capital gain that we avoided when the trust sold the house, right? No one ever paid tax on that, so it gets embedded inside the trust, and so we try to manage it to grow long-term capital gain, so it uses up that embedded long-term capital gain that wasn't paid.
Well, Andrew, one of the other questions I'm sure a lot of people ask you, and I know they're going to ask me, is, well, what about my kids?
Oh, great
If
question.
I give all my money away to charity, what about my poor kids that are they're gonna be upset. You gave all this money to the library and you didn't give me anything. So how do you help them understand that this is a way that they can actually benefit their kids too?
Well, I worked on a deal where they placed their property inside a charitable community trust, and it was $5 million, and so they're getting 6% out of that, and so they're getting $300,000 a year, right? They're getting $300,000 a year. They only need 150, 180 to live on. Even if they travel a lot, maybe 200. So they take some of that excess cash flow that they get, and they place that into a what's called a wealth replacement trust. So if you remember, for you and me, Will, and we're married, that income stream lasts until we both pass away. So second to die, once the second person in the marriage dies, that income stream stops. Whatever left, it goes to charity, right? And so what we do is that for those people that are say, you know what, I don't want to disinherit my kids. I want more of this to go to my kids and the charity. Here's the way to do it. We create a wealth replacement trust with that excess cash flow that they're getting that they don't need, or even other cash they might have. We fund a second to die life insurance policy inside a wealth replacement trust. So at the same time, and that's a less expensive way to do life insurance than just on individuals. So at the same time that money goes to charity, that second to die life insurance policy kicks in, since it's inside a wealth replacement trust, or some people call it an irrevocable life insurance trust. That money, at the same time that the money from the charitable trust goes to charity, the money from the wealth replacement trust, we place some of that money that goes to charity to the kids. Voila, everybody wins, right? And that is a tax-free gift too. So that through the irrevocable life insurance trust, it's not part of the taxable estate. So it's going to be a estate and gift tax-free gift to the kids. At the
Because
same time, the other money goes to charity.
because that money is coming as a payout from an insurance provider and not being transferred from mom and dad directly.
Well, also because it's owned inside a wealth replacement trust, which is
Right.
outside the taxable estate.
Right. Now, this kind of stuff seems really complicated for a lot of folks, and we know a lot of attorneys. And so I know that, you need to do this in advance of a sale.
Correct.
And I would say give yourself at least a month. If you're thinking of listing your house, today is May 13th. If you're thinking about listing your house on June 15th, you need to call Andrew today or tomorrow to give him enough time to go through your financials, to talk to you, to get to know your plans and your goals, and then to kind of circle in and pull in an attorney who can draft the trust. They need a couple, 3 weeks minimum. Longer is better. So a minimum of a month, better would be 2 to 3 months. Is that correct, Andrew?
Yeah. So the process is that you want to have the trust drafted, and I've worked with attorneys that if it's in a rush because something's going to happen, that they can do in a week. I'm not going to promise that, right? And for both Will and I, we don't get any referral fees from these attorneys. I just want the peace of mind that it's done right, because this is an advanced estate planning trust. It's not your revocable living trust. It's not your family trust. Your family trust and your living trust has no income tax benefits, capital gains tax benefit, estate tax benefits. This is an advanced trust. It has to be drafted. And so we want to make sure it's done correctly. But you do want the trust drafted. And then what you do is then you transfer the property into the charitable trust. And then you would engage, Will, or your local real estate broker to list the property, and you're not selling it, your trust is selling it.
Right. Now, I mean, I've spoke to you and some others that, the cost of setting this up is going to run anywhere from, 10,000, maybe a little bit less, up to 20 or 30,000, give or take, depending on the complexity of your situation. Is that about right?
Yeah, I would say anywhere between 5 and 25,000, depending on the attorneys that you use. Um, uh, I've got great relationships with attorneys that use. If I'm involved, we can help cut down some of the billable hours.
Right.
And so it might be on the lower end. Um, And
And who
but
manages that trust then, Andrew? Was that you or the seller or the homeowner?
we can have a formal trust company be the trustee, but oftentimes the owner of the home, the grantor we call it, can be the trustee on it, and I can guide them through how to do that. And we can speak offline on how to optimize it based on their needs and what their comfort level is. Um, and there'll be tax returns filed on behalf of the shared remainder trust, although it's just tax exempt trust, so the filing is not difficult. But and Will, if you're you mentioned they should reach out to me, I guess after the call or in different things, you can provide my contact information. It's fine. I'd be happy to discuss any relevant situation that they might have. And again, this is only one technique, but this is a great technique to avoid paying the capital gain when you sell real estate, whether it's commercial, a rental, a duplex, or your home,
This can
right?
also work for a business sale, right? As
This worked
well.
for a business sale. I've done it for business sales, $65 million business sale, right? So,
Right.
or even a $14 million business sale. So this works for that too. But this works if you want to sell. If you don't want to sell, this is not the technique for that, right? If
Right.
you want to sell the real estate, this is a great technique to avoid paying a capital gain when you sell at the time of sale. You get an income tax deduction, you get the asset out of the estate, and you get a cash flow for the rest of your life.
Yeah, I mean, it's a phenomenal and very powerful tool that I think more people really need to explore. Um, as you know, a lot of the folks that are baby boomers, and I qualify as the tail end of that baby boom generation. Um, a lot of folks in our generation are going into retirement with their home being their primary and most substantial asset, and they're concerned about, what if I sell my house? you know, I don't know what I'm gonna, they need to sell their house maybe because it's too big, but they're worried about all these different things. And I think this is a great vehicle for people to go, you know what, I can replace the income because a lot of people think, well, maybe I'll just, take a second mortgage out of my house, or I'll get a HELOC for the house. And that's where I'll fund my retirement through that. And it's a very inefficient way, and it's not very practical. This is a very practical way. If you are thinking about downsizing or relocating or selling your house, this is a great way to maximize the sale and the benefits of it, and not give Uncle Sam 30+% of your profit that you get from taking care of your home for so long and helping it appreciate. I think we're about ready to wrap up here. Andrew, why don't you go ahead and provide everybody your best contact information, your website, your phone number, whatever you're comfortable providing. And after this is done, I'll make sure it's superimposed on the screen and everybody has that information.
Yeah, the best number to reach me at would be my office line, which is 949-717-3977. That's 949-717-3977. And my email address is andrew.low. That's Andrew as it sounds, .low, LOW, at ubs.com, ubs.com. I'm born and raised in the Valley, and I have relatives in the Pasadena area, and I live down here in Irvine. So I'm very familiar with the real estate scene in Southern California and what angst real estate sellers are going through. So
Yeah, there are definitely a lot of those people that could use your help. If anybody wants to reach out to me, if you have any questions or thoughts, you can contact me on my cell. You can either call or text me at 310-920-1108, or you can email me at will.flanagan@compass.com, and it's will. And my last name is spelled FLANNIGAN, will.flanagan@compass.com. And thank you so much for watching. Again, appreciate Andrew and all your expertise and your time. It's been a great pleasure learning more about how charitable remainder trusts are used and how they can benefit people who are thinking about selling their home. So
well,
thank
great.
you.
Thank you for taking great care of your clients, and blessings to all of you there today in Southern California.
Thank you, sir.